Welcome to Property Addicts Australia, your home for everything property investing. Get an insider's view of what really works when building a portfolio. Learn how to avoid the common mistakes, plus get all the tips and tricks from the property investing experts Sana and Mona Ali. Join us to learn from the experts and set yourself up for long-term success in property investing. Proudly powered by propertytwins.com.au.
Welcome to the Property Addicts Australia podcast. We are Sana and Mona Ali, the Property Twins. We are investment-savvy mortgage brokers and buyer's agents. We help clients all over Australia build investment property portfolios. In this episode, we'll be talking about how to get property right for your portfolio. We'll be talking about the risks with brand new and off-the-plan properties. We'll also be shedding light on analysis paralysis and how you need to be meeting the market. We'll also be talking about what to watch out for at the property level so you only buy investment-grade properties. So most investors give up after their first investment property because they may buy a lemon investment property and make expensive mistakes, which in turn impacts their confidence levels in terms of property as a vehicle to generate financial freedom, security, and stability. And they may buy a property in a dud location, which impacts their future cash flow and capital growth. And they're unable to then progress or move forward from there on. We've also seen investors seek input from property brokers or even buyer's agents who've never bought property before. Also, people sometimes even give up too soon and don't have the patience to see the markets grow. Property is a long-term asset which grows over 10, 20 years. And we've seen people actually sell out of markets because of their lack of patience, that the growth just wouldn't come soon enough. The goal needs to be for them to buy in the best possible location for the best possible price and let the market do its thing. It's not overnight get rich quick scheme. We see investors buying brand new off-the-plan properties, and these properties are really sold just for tax reasons so investors can save tax. These are usually sold by developers, agents, and there are many shiny brochures attached to these sales. And what you don't realize is you're often overpaying for these properties. What this means is you are overpaying for these brand new off-the-plan properties, and generally they are 10% or more expensive than established properties in the same area. So you're overpaying effectively to get some tax depreciation benefits. So you may get 37 cents in a dollar back or whatever your tax bracket may be. So you're effectively losing money to save tax, and losing money is not a strategy. Tax depreciation is actually a timing illusion. When you actually sell the property, all these tax depreciations that you've claimed over the years need to be taken off the cost base of your asset. So you eventually have some capital gains tax implication associated with this. So make sure that you're actually seeking tax advice as to whether this is even beneficial to you in the long run. We often hear people say that I'm getting this property for free or I'm not paying for a service. What you need to really know is the developer's agents are working for the developer and their commissions run into tens of thousands of dollars. And ultimately, it's you who's paying for it. It's already factored in the price. Also, it's important to consider the timing of the purchase of such a property. You need to be mindful that eventually everything will increase in value with inflation over the next 20 years. But the challenge arises if you buy the property at the wrong time. So we've had clients who've been sold these off-the-plan properties in, say, the peak of the Brisbane market and in, say, 2017. And they've held these properties for several years with no growth. And what that means is they have not been able to tap into the equity to expand that property portfolio and buy more properties. So timing is also important. And consider that if you're overpaying for a property, you'll be waiting for a very long time to access the equity. When you do sign up for these off-the-plan properties, many times the property may not even be ready, and it might be months, if not years, before the developer actually starts building this property. So in this time, what if the developer goes bust or the builder goes bust? So what happens with your resources? So whilst you're waiting for this property to be constructed, you will lose out because the rest of the market may progress during that time and continue growing. So Either you lose your deposit, or if the builder goes bust or the developer goes bust, then you lose out on the capital growth because your money won't be able to buy you the same quality asset.
Also, you need to be mindful that your life circumstances could change, right? You might have a growing family. You might have signed a new rental lease in that time frame and therefore unable to settle on this new purchase. And if your circumstances have changed, coupled with the lending climate changing, how do you settle on a deal? You may not have that many options left, as opposed to when you started and you had several options of lenders to go to.
What you need to know is with established properties, you are not paying a premium for the property. You are potentially buying a bigger block of land. You are also doing building and pest inspections, which will tell you if there's something wrong with the structure of the building. Whereas with brand new properties, you effectively waive the right to be able to do these building and pest reports, because at times the settlement is months, if not years down the track, because the property has not been built. And by the time you come to settlement, you're not really going to do that or be able to pull out of the deal because of the structure of the building. In recent years, there's been a number of cases where there's been issues with buildings in Sydney which have not been built to a standard. So effectively, you are waiving your right and you may buy something which may cause problems down the track.
That's partly because the settlement may not happen for a very long time. There's a lot of uncertainty, right, with these purchases because your life circumstances may change. So make sure you're keeping control of the situation, and that only happens when you're buying established properties. As you can tell, we are not huge fans of the planned properties. They may work, they may grow over a period of time. Whenever we've done our numbers, we've found them to be not a sound investment strategy. So what we need to know is investing for depreciation is not a property strategy. Losing money is not a strategy. Sure, tax benefits are important and really help with the holding cost of the property as you go along. And you do get benefits even on established property where you can save tax and enable the holding costs. But it should be an icing on the cake and really not the key driver for your investing.
So tax depreciation will help with the holding costs. It will minimize the cash outflow month on month, year on year. So it's a great thing from that perspective. But you need to take into account that when you come to selling the property, your cost base will be adjusted with the deductions you've claimed previously. And it might result in a higher capital gains tax bill down the track. So make sure you get accountant advice in deciding whether this is the right thing for you to do or not.
We compared two properties in the same area, purchased in 2009, and the comparison was done over a period of 14 years. There was a unit, which was brand new, purchased for $360,000. And then there was a villa, which was a little bit older, around, say, 15 years, and it was purchased for $330,000. As you can tell, the villa had some land component. It was bigger, a little bit older, but cheaper in price at $330,000. When these two properties were compared over a period of 14 years later, the unit was worth $500K with similar properties selling at that price, which is 38% in growth since purchase. And the villa had similar properties selling for $700,000, which is 112% in capital growth over the same time frame. So as you can tell, the older property, which was cheaper, grew more because, one, we didn't pay premium for it, or the buyers didn't pay premium for it. And there was also bigger land component. It just offered more to the buyers or to the investors. So the comparison shows a staggering difference. The investor who bought the unit for $360K and now worth $500K would not have been able to expand their property portfolio in these 14 years, as opposed to the investor who bought the villa and had 112% in capital growth would have had ample equity to expand their property portfolio in this time frame. So you can see the opportunity cost runs into hundreds of thousands of dollars. You can't see that today, but you will. With a long-term focus, it's important to see how the property will benefit you and your longer-term goals.
So what we find is that investors get stuck with analysis paralysis and unrealistic expectations before they decide on a property. We've had people come to us after 10 years of research and working with contradictory information and not taking action in that time. So time will pass anyway. And then there are investors who are looking for a great deal, but they're not willing to meet the market. And before they know it, the market has moved 10 to 20%.
People also get stuck listening to the media because the media changes the story and the narrative every day. One day the market's booming, the next day the market's not. And where people run into challenges is looking at historical data. So in a rising market, when the market's rising week on week, it's so easy to get caught up on this property sold for this much last month, and that's what I will be paying, not realizing all the 50 other people who miss out on a property will be going to that next open home and actually paying more. And again, we're not encouraging you to pay more, but what we're trying to say here is analysis paralysis can really have you stuck and missing out on a lot of growth that you could capture, because in 6 months, the market might be entirely different.
And I guess there's a disconnect between what one may be willing to pay for a property and what it's actually worth. And that it goes back to what you were saying, that people just rely too much on historical data. It's an important part of what you're looking at because that will show you the patterns and where the market is heading. But in a rising market, you can't just rely on historical data. You need to take the information and apply it and take action so you're in the market, not outside the market.
Due to endless research, inability to take action, and unwillingness to meet the market, investors actually miss out on hundreds of thousands in capital growth.
They're then priced out of the market and they have to then settle for an inferior property, which no longer meets the original criteria they set out to achieve.
The analysis paralysis and unrealistic expectations lead to endless research, inability to take action, or not being able to actually decide on a property. What this means is you miss out on hundreds of thousands in capital growth and cash flow.
This leads them to then being priced out of the market because the properties that they were originally targeting are now selling for much higher than their original budget. And then they have to settle for an inferior property than what they could have afforded earlier on. To avoid analysis paralysis, you need to look at your own economy, not listen to the media, not listen to what other people are doing, and just focusing on your goal. And also work closely with your broker to work out the purchase price that you can target, the rental return that you must achieve, and having a plan on how you're going to actually make this happen for yourself.
Also do your research with qualitative and quantitative factors. This includes firstly the data that you're looking at, couple that with the infrastructure spend that's happening in the area to enable the purchase, and most importantly, consider the rental yields in the area. The rental yield is often inversely proportional to the capital growth and a good indicator of the capital growth that's to come. Don't forget to also couple that with what's happening on the ground. Often people get so stuck with the data and the research that they completely miss the fact that on the ground might be a totally different story and people might be paying different prices in a moving market in particular.
Whilst it's important to do your research, avoid talking to lots and lots of people because that will eventually lead to confused knowledge. So talk to people, but obviously limit what information you consume. This will only lead you to confused knowledge. So what you need to know is that it's about time in the market, but it's ultimately comes down to you taking action. You need to look at what your resources are, manage your expectations, what does your budget allows, and effectively come up with a list of negotiables and non-negotiables that you're happy to put up with. You don't need to obviously compromise on the qualitative factors that you are looking at in a property, but again, you need to be realistic as to whether your budget allows you to purchase in a particular area at a particular price point. If not, then you need to tweak the strategy and move on to another location.
Well, we have had clients who've come to us after 10 years of research when they could have bought 4 300K properties in Sydney for $300,000. And they've come to us 8 to 10 years later, and they've missed out on so much growth. And the same properties today would be worth 7 to 800K each. And then we've had clients on the other hand who've taken action and bought back-to-back investment properties sub 350K in Brisbane in 2017, and the same properties are worth 700K. So as you can see, analysis paralysis is very costly. So you need to be very clear. With clarity comes certainty. If you don't know what you're looking for, if you don't know where to align your expectations with your borrowing, with your life circumstances and what stage of life you're at, then it's going to be a massive opportunity cost over the long term. You also need to know that no property is perfect and there's never a perfect time. The perfect time is when it's right for you and your life circumstances and your resources allow you to get into property investing as and when you can buy. That's what we did, purchase properties as and when we could, when our resources allowed or equity allowed. And that's really different for every person.
So what you need to know is it's about time in the market and not waiting for a perfect time to take action. You need to look at your resources, manage your expectations, come up with a list of negotiables and non-negotiables as to what you're looking for in a property. But at the same time, you need to be realistic just to make sure that you're able to meet that wish list and you're able to purchase the type of property you're after in a particular area. In the event that you are unable to afford a property in an area, then you need to re-strategize and redo your strategy and go back to the drawing board. You don't need to compromise on the qualitative factors. They are all important, but you need to have a realistic approach to what is possible in your budget. People talk about hotspots and locations, but we also need to look at property level information. So data is the big thing these days, and even property gurus and buyers agents, coaches refer to data. However, this ignores granular level of detail that you need to look at for each individual property that you are considering buying.
People also talk about positive cash flow. I want a positive cash flow property, but what they don't realize is positive cash flow is also a function of interest rates. So with interest rates going up, most properties are going to cost you something to hold. And also cash flow shouldn't be the only driver for choosing the property, because positive cash flow can quickly erode with maintenance costs or the quality of tenants you have in the area.
What this really means is that you're ignoring vital red flags about a property, and just because the data said so, that, you know, it's a great location or it's positive cash flow, you may be buying a property that actually has various hazards, like environmental hazards. So effectively, you may be buying a dud property for the sake of temporary capital growth, not taking into account that there may be resale value issues with this property.
Sole data focus can artificially inflate prices and mislead investors into buying properties in locations where, you know, it may be just an investor-driven demand pushing up the prices, and it may not be stable in terms of long-term growth. Purely because people are buying because data said so doesn't necessarily make it a good investment. So you really need to consider looking at the property level itself, because a dud property will always be a dud property regardless of which hotspot you buy in.
So solely focusing on the data and not looking at property level detail, you may find your property not being investment grade, and in a non-investment grade property will always lag behind in capital growth over a long period of time.
You also need to consider the environmental hazards, right? In an area, overlays such as bushfire hazards, floods. You need to look at the vegetation on the property and what could really impact you. And data or cash flow analysis doesn't really reveal all those factors that you need to be mindful at a property level. What you really need to look at includes the hazards at the property. What are the environmental overlays, such as floods, bushfire hazards? You need to look at the zoning. Is there any development happening around the property? Does the block offer you any upside? And can you do anything with it subject to council approval? You also need to look at infrastructure, such as what are there trains, buses around the area? What shopping malls are near the property? What investment is really happening around the property?
And you also need to look at easement. So there may be some publicly available data around easement. So there might be an easement on the block, which may impact the future development potential of that particular block of land. So you need to weigh that up, whether it actually impacts the property and if you should proceed with that purchase. And then for strata properties, you need to look at how many villas or units or townhouses are on a block of land. Is it high density, or is there pools, gyms, or tennis courts, or if there's an on-site manager, which may indicate that the strata cost might be quite high. And another risk with this sort of a property is that if there was a fire sale in the block that you have purchased, and it will bring the value of your property down. And then there is age of the property. So you need to weigh up your actual risk profile. So some people are okay with older properties. So you need to be mindful that older properties come with high maintenance costs. On the other hand, if you buy a newer property that may be set and forget, then you won't incur the maintenance costs for quite some time to come. So weigh up what's important to you, what your risk profile allows, and take action accordingly.
Well, ultimately, you will be doing a building and pest report on the property. So an older property which is well maintained and is tidy might be okay for the portfolio. But again, it comes down to individual risk profiles.
But also note that older properties may come with a larger land component, whereas newer properties may be on smaller blocks of land.
You need to consider the topography of the land. For example, if the block is sloping back, there could be potential drainage issues. If the property has retaining walls, these are quite expensive to repair over the time of your holding. You also need to think about the vegetation and the trees on the block. Large trees could say lift up a driveway or get into the plumbing of the house, can be very costly to remove from the block. Also check if there's any electrical grids or power pylons or electrical boxes on the block. This could be perceived as a health risk. And also if you're paying lender's mortgage insurance, your lender may actually not like that property.
And you need to see if a property is actually backing a main road or a train line, because, firstly, these type of properties are looked down by the lenders, and most people don't like these because of the noise associated with it. And you're going to have challenges when it comes to selling this property. And then there's conversions, right? Like, for example, garage conversions in a property. So you need to be mindful if you are buying a property that has had a conversion done, the insurance may not cover that part of the property, which may cause issues down the track. And then there is property ownership. Some states have this data available through paid sources where you can see the ownership of other properties around your property. So there might be some state housing. So this is not available for all states. So it's only available for a few states. So you can actually tick that off as well to see whether your property is actually surrounded by a housing commission.
Going back to property level side of things, make sure you always do your building and pest and electrical reports, because that would pick up important issues with the property that, depending on where you're buying, you might be able to negotiate on or terminate the deal if the property doesn't stack up or it's outside your risk profile. Look at getting the relevant insurances as well, right? Building insurance and landlord insurance. And in some states, the risk of buying a property passes to buyer once you sign the contract. So make sure you're covered and seeking the correct legal advice so you're protecting yourself and your asset. It's also important to consider the resale value of the property, right? If you have a question mark in your mind about a property or what it's presenting to you, be mindful that other buyers might be thinking the same. At property level, you cannot fix the slope of the block or the drainage issues that you might run into, or the trees on the block. So think about if there will be resale value for this property with its positioning on the block or how the house is sitting on the property. Many people don't think about it. The industry is really focused on just the data, the numbers, number of properties. But often people just forget and miss the fact that if you buy a dud property at the property level, you will have the same issues when it comes to selling this property.
So we believe in building a sustainable portfolio made up of quality properties. So it's not about the quantity of properties, it's about quality of properties, especially in the current climate when lending is much tighter than it ever used to be for investors. So you need to make sure that you're adding quality properties to your portfolio because you may not be able to achieve that magic number that you set out to. So talking about off-the-plan properties and the impact they could have on your future capital growth and the trajectory of your property portfolio, I wanted to share a case study of one of our clients, Tom and Kelly. So Tom and Kelly purchased a townhouse back in 2009 at the peak of the Brisbane market for about $360,000. As of 2020, this townhouse was actually worth $250,000. And in 2023, it was worth about $360,000. So they were still in the negative because they had paid stamp duty on this property. So had they purchased, say, even a house in Brisbane at that time for an equivalent price at the peak of the market, that house may be worth sub $700,000 today. And it would have given them equity over time to be able to expand into multiple properties. But buying this off-the-plan property has been quite expensive for them because firstly, it went into negative growth over time and they weren't able to tap into the equity and they weren't able to multiply their asset base as a result. And that's because they actually paid a premium for a property when they could have just bought like an older established property on a larger block of land, which would have given them a grounding to build a property portfolio.
We are talking about them buying in Brisbane, right? An established property at that time. But if they bought this same price property, $360K in Sydney at the time, the property would be worth close to $1 million today, and they would have expanded that portfolio significantly. This signifies not only the capital growth you will get on an established property as opposed to a brand new property, but also the power of property cycles and where you are buying at what point in the cycle.
Yeah, they would have obviously been able to claim deductions for the depreciation, but, having negative equity means they've obviously been missing out on the growth that they could have had over this time.
Well, the cost runs into millions of dollars and maybe a few $1 million because they could have tapped into the equity from this first purchase and bought maybe 3 or 4 more properties in rising markets.
Thank you for listening. Join us next time for another episode of Property Addicts Australia podcast.
Thanks for listening to Property Addicts Australia. For future episodes, click follow. Leaving a review helps others find the podcast. And for more information about how we can help you, visit propertytwins.com.au.